everyone, very good evening. You're watching The Money Show on ET Now. This is your one-stop shop for everything to do with your personal finances. I'm Mubina Kapasi, and here's what we have lined up for you on the show. We are going to talk about why investors redeemed their mutual funds in July. Well, not all of them, but a majority did redeem more than they invested in or did SIPs in. In fact, the average SIPs as well in the month of July did fall quite a bit compared to what we've seen in the past. So what's the reason? Has it been the fact that many investors in mutual funds as well want to take advantage of this rally in the markets and want to exit? Should that be your mutual fund strategy? And we will also be talking about which category of mutual fund, large cap, mid cap, multi cap, saw the most amount of investment and which saw the most amount of redemptions. All of this lined up right here on ET Now. Later on the show, we'll be addressing the fall in gold prices after the rapid rally. The last few days, we've seen gold prices come down quite a bit. So what's in store for gold prices and silver prices? And finally, later on the show, we will be talking about buying a house, but something that is available on auction. How can you buy a house via bank auction? What should you be careful of? Are prices really significantly different? That's what we will be talking about on today's action-packed 1 hour long episode of The Money Show. So stay tuned. Well, without any further ado, let me introduce our very first guest on the show, Mr. G. Pradeepkumar, the CEO of Union Asset Management Company, or Union MF. Mr. Pradeepkumar, thank you for joining us today on ET Now. And you know, when we did see the AMC numbers in the month of July, it sort of baffled us to think that why did mutual funds, why did investors essentially press the redeem button or the exit button more than they actually wanted to plow in money into mutual funds? Because we saw net outflows away from mutual funds. So was it the fact that, individuals and investors are looking at this rally in the market and thinking, you know what, make hay while the sun shines, let me just remove money because the market has rallied?
First of all, thank you, Mubina, for having me on the show. My pleasure. And before we get into detailed discussions, I would like to make a general statement. The COVID and the lockdown has been, something that the world has never seen. And it has affected the whole country in many ways, in differing ways. Every industry and every individual has been affected. So to expect that mutual funds will remain immune from the effects of COVID is not a realistic expectation. So mutual funds also would be affected, and we need to accept that. Now, having said that, the redemption numbers in July, my feeling is that it's driven primarily by profit booking. There has been a rally of more than 46% since the end of March. And many people made too much money too quickly and might have decided to take some profit off the table. So that's one factor. Second is that as the lockdown continued, the economic hardship has also continued. And there are many people, especially people who have been running small businesses who face cash flow problems. And many of them found that the easiest investment to sell in such a situation was their mutual fund holding. The prices were good, it is very liquid, and they might have decided that it's better to liquidate the mutual fund because their investments in other assets such as the real estate or gold were not not so liquid. So in a way, mutual funds were a victim of their own success. Because we are liquid, because we offer a fair value, people might have chosen to redeem their mutual funds first. But I wouldn't see any alarming trend in the redemption per se, because it's only natural that when people have made money, if they want to book part of the profits, that's something that we have to live with.
Okay, well, fair enough. But for mutual fund investors, do you think that should be a strategy? Because, we often say, and especially if you're an equity mutual fund holder, if we look at the July flows, the maximum outflow has happened from, equity mutual funds. So a multi-cap fund has seen a big amount of net outflow. Small cap still, it's a little restricted, but it has seen a net outflow. All of these are the kind of funds that we often say, and, a lot of our personal finance experts as well often say that, look, if you're having a large cap fund or a mid or small cap fund, you should ensure sure that you're investing in it for the long term. But here you have investors who, have seen a bit of green on the screen and they're thinking that, let me move out of here and move to maybe gold or any other asset that seems to be a bit more lucrative. Do you think that should be the right strategy? I mean, do you think that investors who invest in mutual funds should be tracking the market with such nuances and, exiting the minute they see a little bit of green?
Absolutely not. In fact, mutual funds, you're absolutely right, Movina. It is for long-term investors. And when we say long-term, we would say an absolute minimum of 3 years, ideally more than 5 years, as far as equity mutual funds are concerned. So if people, invest in equity mutual funds with the expectation of making money in 3 months or 4 months, that is completely unrealistic. And I would even call it a dangerous trend. However, it has happened. People who invested even earlier, not in March or April, people who had invested even, in the earlier years, maybe 3 years or 5 years back also, might have felt the need to take some money because of cash flow problems. And they might have decided that, the rally in the market has given them a good level at which to book profits. So while short-term trading in mutual funds is to be completely discouraged, we cannot wish away profit booking at some level, because even long-term investors at some stage may think that, from an asset allocation point of view, they would like to reduce their equity allocation a little bit and move perhaps towards, fixed income. So that is probably what has happened in July. And I would not really, think that it's a long-term trend or people have become, short-term traders in equity mutual funds, etc. Quite the contrary, all the data points towards the fact that, investors are taking more and more long-term approach while investing in mutual funds.
Okay. Yeah, it's important to take a long-term approach to investing, and there's no question of, deciding to trade in mutual funds. That's just completely, it really does not make any, financial sense to do that. Okay, well, that's essentially how you go about it, and perhaps giving an explanation to why investors have pressed the redeem button or the exit button. Let's talk about now individual categories. The one category that caught my eye is the balanced and arbitrage funds, which have actually seen the most amount of redemptions or exits during Q1. If you could just explain to our viewers, firstly, who may not be aware, what exactly are balanced and arbitrage funds? And I mean, I know they're considered to be maybe hybrid funds or debt funds, but looking at the current macroeconomic situation, do you think these funds are good to hold on to, or do you believe, just like a majority of investors, maybe you could redeem a little bit over here?
So, these two funds are, of course, very, very different funds, Balance Advantage Fund and Arbitrage funds. So if I take Balance Advantage funds, so they are, again, primarily a long-term vehicle. The difference between a pure equity fund and a Balance Advantage fund is that Balance Advantage funds have dynamic asset allocation, which means that there is an inbuilt mechanism in such funds which reduces the equity exposure when the market valuations are high and increase the equity exposure when the valuations come down. So this effectively reduces the volatility in Balance Advantage funds. So that is the most important thing about Balance Advantage fund. So these funds over a period of time, and when I say over a period of time, I would mean, at least 3 years, similar to that of equity funds. And, they give you nearly equity market returns. At times, they may give you better than equity market returns also, but at a significantly lower volatility compared to a pure equity fund. So people who do not like the roller coaster ride of a pure equity exposure may prefer to invest in Balance Advantage fund because you get very decent returns over a period of time, over more than 3 years, with significantly lower volatility, which means significantly lower risk. It also means that the flows into Balance Advantage funds will move generally in tandem with the flows into equity funds. So if equity funds are seeing a net outflow, it is very likely that Balance Advantage funds will also see a similar trend. Because when equity funds have gone up, the NAV goes up, Balance Advantage fund NAVs also go up. may not be to that extent as a fully pure equity fund, but they also go up significantly. So that means that a certain level of profit booking, if it happened in equity funds, might have happened in balance advantage funds also. So that's one factor about balance advantage funds. Now coming to arbitrage funds. So arbitrage funds are among the lowest risk category funds. No fund is without risk, I have to state that. But among the funds, relatively, they are among the lowest risk category. Now, these are ideal for parking funds for relatively short term. And when I say short term, anything more than 3 months. Now, if you move into arbitrage funds, you need to have a minimum horizon of 3 months. Because less than that, arbitrage funds returns could be volatile, could be very low. At times, they have even been negative. But if you stay for a minimum period of 3 months or plus, arbitrage funds tend to give you very good returns. When I say very good returns, it means normally better than what you get in a bank savings account, or very often these days what you get even in liquid funds at times. So what happened is that in July especially, the returns from arbitrage funds came down compared to what was there in the market earlier. And this depends on a number of factors, the cost of carry coming down, etc. So when the returns came down, probably many investors decided not to park their funds in arbitrage funds and might have chosen to move their money more into liquid funds and ultra short-term funds, etc. So, which is why we have also seen a significant level of inflows into the short-term debt funds, such as liquid fund, ultra short-term, short duration funds, etc.
Okay, that's going to actually be my next question. Yes, maybe they were unhappy with what they saw in the arbitrage funds and decided to move to liquid funds and short-term debt funds. And yeah, that's where really we are seeing a lot of inflows come in. How are you viewing liquid and short-term debt funds in this current interest rate scenario? Because the RBI governor has said that, look, interest rates are going to be weak for a while. And that's the reason why, even fixed deposit accounts, savings accounts are all going to be very, very non-attractive or unattractive investment, or it's not going to be a great option for people to park their money. Do you think liquid funds and short-term duration funds would offer better prospects? And if, somebody just wants to temporarily park their money and they want easy liquidity as well, these would be better options?
See, again, it depends on what is the priority for a particular investor, and depends on the individual investor. So I would give a comparison between liquid funds or ultra short-term funds and say bank deposits. So the advantage of a bank deposit is that you get a guaranteed rate of return. Okay, but that rate typically tends to be quite low. These days in savings accounts, you may get say 3% or thereabouts. Okay, while liquid funds have the potential to give much better returns compared to savings account. Now, that does not mean that on a given day, liquid fund will give you better returns than savings account. So, since all securities under the current SEBI regulations have to be marked to market, even liquid fund returns will tend to be volatile. So, for example, liquid funds on a given day may give you 5% return, and another day they may give you 2% return. But if you stay for a few days, maybe a month or so, the returns tend to even out and you get a fairly good average return. Now, if you compare liquid funds with fixed deposit, there is a significant difference, which is that liquid funds offer you complete liquidity. There is an exit load only for 1 week. And after that, anytime you can liquidate your investments. There is no exit load after 1 week and there's no penalty. While in the case of fixed deposits, you may have a penalty if you want to liquidate your deposits prematurely. So for people who value the comfort of a guaranteed return, a fixed deposit may be a preferred option. But people who are willing to sacrifice that guaranteed return comfort and would also value the liquidity that mutual funds offer, liquid funds or ultra short-term funds, etc., they would probably be better off with the short-term income category, that is, liquid funds, ultra short-term funds, etc. So it is a question of what the investor is willing to sacrifice or what he prefers. So those who prefer liquidity should certainly come into mutual funds, and those who prefer the guaranteed return and the comfort that it offers them, yeah, they are probably better off with bank deposits. They may get lower return, but that is what they have chosen. Now, one more point to keep in mind, you mentioned this very correctly, that all the indications today in the debt markets is that the interest rates would continue to remain soft and they will come down further. Now, this also offers an opportunity to make extra returns on fixed income funds, because in addition to the accruals, you also stand to gain from the mark-to-market gains. As most people know, when interest rates fall, the price of debt securities go up. So that opportunity is there. And since all securities are mark to market, even a liquid fund or an ultra short-term fund can benefit from a drop in interest rates. So there is, in addition to the accrual, there is a possibility of capital gains also. So for investors who are willing to take a bit of volatility in their returns, I would certainly say liquid, ultra short-term, short duration, all those funds offer a very good option.
Okay. Yeah, that's an interesting point you made, that when interest rates are low, there's this entire mark-to-market bit that comes in. Just for our viewers, a brief explainer on that. If you're holding a fixed income bond that promises to pay you a certain interest rate, and if in the market the interest rate goes lower, then obviously that fixed interest rate bond does tend to become very attractive because it will be higher than what the interest rate is in the market. So the value of that particular fixed income instrument does go higher, and that's essentially what MTM or mark to market gains as well do mean. The value of your fund as well does go higher. So when interest rates go down, fixed income funds definitely do offer quite a good proposition for investments. All right. I want to talk about two other fund categories, and these were in fact the only two fund categories within the equity mutual fund universe that actually did see net inflows come in. One is the value funds, and the second one is the focused funds. Why do these two funds essentially stand out the most?
So, in fact, as far as I could see in the numbers, nothing really extraordinary has happened in either of these categories. So, value fund, focus fund, if you take the last few months inflow has been fairly steady, and the only extra inflow that has happened in July can be attributed to one NFO of a focus fund that happened, which gathered about 500 crores. So if you remove that, nothing has changed as far as the focus fund category is concerned. Coming to value funds again, as far as the inflows are concerned, the trend has remained the same. There has been no, unusual inflows into the value fund category. Of course, it's a fact that the value stocks, and what we normally call the value stocks, have started performing better in the last few months, and there has been certain level of value unlocking that has happened, and the value funds as a category which were not performing very well until some time back have started performing well now. So that is an interesting part of the whole value cycle, because in value funds typically what happens is they may lie dormant for quite some time, and there will be suddenly a period when value unlocking happens. So it is only for people who are willing to be very patient and wait for that value unlocking. But looking at the numbers, nothing really extraordinary has happened in those categories as far as we could see.
Well, yes, when you have a new NFO, a new fund offering rather, that too does tend to attract fresh capital. So it's possible that these two funds as well did see momentum come by when it comes to inflows because of that, and investors shouldn't really get confused when it comes to that. Okay, I want to get in your word on, how or according to you, how should investors position themselves in the different mutual fund categories, be it equity or debt? I know it's going to, of course, depend based on your time horizon, but let's assume that for our viewers who are maybe 25 or 30, so they are on the younger side, they have a long-term time horizon, they want to invest for their future, for retirement, for general wealth creation. How would you request them to essentially invest across the mutual fund spectrum, from equities and towards liquid as well?
So that's something which is, I think, relevant for a lot of people, particularly youngsters. And I would say, if you had to choose one fund, and if your risk appetite is relatively low, probably the best fund that such investors can choose might be the balanced advantage fund. Okay, because it alternates between equity and debt depending on the market valuation levels. So you get exposure to both the categories, and it maintains a lower volatility. And as I mentioned earlier, in response to another question, the returns tend to be very close to, or sometimes better than, equity market returns. So that's one category of funds which I think every investor, particularly those who are in the early stages of investment, should look at. Now, again, if you had to choose one equity fund in the pure equity category, I would certainly recommend a multi-cap fund, because that gives you exposure to large cap, mid caps, small cap, everything. And if you want an exposure, overall exposure to the equity market, the best thing is to go for a multi-cap fund. And as has been said in various forums, there is no better way than an SIP to build up wealth over a period of time. So an SIP in both these categories of funds would be highly recommended for people who are either 25, 30, 35, or even 40, because it gives them time to build up the wealth. Okay. Now, for another category of investors, who are looking at, say, who don't have a 3-year or 5-year horizon, who are looking at, perhaps the next 1 or 2 years, and they have, definitely some financial commitments to be met after, say, 18 months or so, I would advise them to look at the dynamic bond fund category and the corporate bond fund category. Because our view is that over the next 1 year and 18 months, interest rates are likely to remain soft and they can come down further. So you may make good returns from good bond funds, good corporate bond funds, and dynamic bond funds. And you could even look at the banking and PSU fund category. So that is, from a short-term or medium-term investment horizon. Now, there is another category of investors, who are more mature, more involved, and they already have a reasonably diversified portfolio across fund categories. They may have multi-cap and a bit of exposure to small cap, mid cap, etc. For such investors, I would say diversification is a good strategy. And if you have noticed the numbers, 2 categories where there has been inflow, not only in July, even in June, one is gold ETF. So, that is also a good way to diversify away from equities. The second category is funds investing overseas, fund of funds investing overseas. So people who have a very well diversified, rich portfolio in the Indian equity markets, they may look at diversifying a little bit in international markets. And there are enough funds available in the market which offer that opportunity at a very low cost. So I think, this is the way to probably build up a portfolio depending on the life cycle of the particular investor. Of course, each investor's situation could be different. So, investors would be better off seeking customized advice from their financial advisors or distributors. But in general, I think this is a principle that they can follow.
Absolutely. But Mr. Pradeepkumar, nevertheless, you set them out on the right path by guiding them on how, they can as well kickstart their entire investment journey. Thank you so much, Mr. Pradeepkumar, for joining us today on ET Now. This entire process of where mutual fund investors seem to be redeeming more than making fresh investments is just about of what we say profit booking. In fact, we have some very interesting data that as the market has risen these last 4 months, the redemptions as well have increased. However, very clear that if you're a long-term investor and your goals are still some time away, then just stay put. Of course, if your goals are nearby, maybe 1 or 2 years, slowly start moving into maybe fixed income funds. Okay, on that note, we will take a very short break right here on the show. Don't go anywhere.